slides.
Yep, perfect.
Yeah. Thank you again for including our paper in the program. Our paper is entitled as the cross-section of monetary policy announcement premium. This is the joint work with Hengjie from University of Minnesota, Laila from University of Hong Kong, and Lai from Syracuse University. The literature has documented that monetary policy has substantial impact on equity market. For example, Bernanke and Cutler 2005 showed that if there's a 25 basis cut in the interest rate, it will be associated with about 1% increase in equity market return on average. More recently, the literature has provided overwhelming evidence that FOMC announcements are associated with a significant market risk premium. For example, Luca Monk 2015 documented this pre-FOMC announcement drift. Cislak, Morse, and Vincent Jorgensen provided evidence that market return follows FOMC announcement cycle. More broadly, Seva and Wilson 2013 document significant market returns on major macroeconomic announcement days. If FOMC announcements are associated with a significant market risk premium, we want to study whether this risk is priced in a cross-section of stocks. In this paper, we find stocks that are more sensitive to the upcoming FOMC announcement. They will earn higher expected returns on FOMC days. And we develop an equilibrium model based on the information channel of Nikamara and Stice in 2018 to rationalize and explain the empirical results. This is the roadmap on how we address this research question. We first construct a measure of expected firm level sensitivity with respect to FOMC announcement surprises. Then we sort stocks based on this measure. We form portfolios and we compare returns on FOMC days and non-FOMC days. Lastly, we develop a model to rationalize and to explain the empirical results. Because I only have 25 minutes, given the time constraint, I will skip the literature review and I will directly go to our empirical evidence. To gauge or to investigate whether expected sensitivity to the FOMC announcement is priced across stock, we first need to come up with an expected sensitivity measure. The first thing we would have tried could be the firm level return beta with respect to FOMC announcement surprises. However, there are only 8 FOMC announcements per year. It's hard to precisely estimate this beta, especially if the true level of firm level sensitivity varies across time. Therefore, we rely on option implied variance. Our intuition is the following. Macro, or in particular, FOMC announcements carry information about the economy and resolves uncertainty in the economy. This uncertainty will be immediately reflected and priced in the option market. Upon announcement, economy-wide uncertainty reduces, implied variance should drop immediately. Moreover, if firms have different exposure to the upcoming FOMC announcement, we should expect to observe a heterogeneity or variation across the firm level implied variance reduction. That's the reason we rely on option implied variance. And before I show you our measure of expected sensitivity, I would like to provide 2 empirical evidence to support our intuition. The first is their implied variance reduction around FOMC days. If we use T to be FOMC announcement days, and T-1 as 1 day before FOMC announcement days, and we observe no matter for the market level, also for the firm level, we observe significant implied variance reduction after the FOMC announcement. This confirms our first intuition that FOMC announcements reduce or resolves the uncertainty in the economy. Second, to demonstrate there is a heterogeneity in firm level implied variance reduction, we plot this histogram of firm level implied variance. And we here, this figure showing the difference between T minus T minus 1. And it's clear that most firms experience implied variance reduction after the FOMC announcement. We also see this substantial heterogeneity across the firm. So this confirms that firms do have different exposures to the upcoming FOMC announcement. To investigate the expected returns, we needed to come up with an expected variance reduction, which we call as EVR. Our intuition is the following. For those firms that are more sensitive to their upcoming announcement, they should be experiencing higher or more implied variance reduction. However, this implied variance reduction can only be observed after announcement. Therefore, it's crucial for us to have this expected implied variance reduction. What we do is, if we observe there's a sudden increase in the firm level implied variance compared to its historical level, then we expect this firm will be more sensitive to the upcoming announcement. Therefore, we construct the EVR measure as the following. EVR equal to RV T minus 2 minus the historical level of RV. More precisely, RV T minus 2 is calculated from the option prices with a maturity of 7 days. We calculate RV T minus 2 days before the announcement because we want to make sure our measure is not affected by the pre-announcement drift. And the historical RV is calculated as the average or median of the day 15 to 8 days before the announcement. Therefore, by construction, RVT minus 2 will be affected by this upcoming announcement, whereas the historical RV will not. Then this will confirm our intuition that those firms that have higher EVR will be more sensitive to their upcoming FOMC announcement. More importantly, we were able to verify that our measure of EVR can predict the actual implied variance reduction very well. When we regress EVR on the actual implied variance reduction, the regression coefficient is highly positively significant with a t statistic equal to 9.6. Then we use this EVR measure to sort stocks into decile portfolios 2 days before their FOMC announcement. And then we document the portfolio returns on FOMC days as well as non-FOMC days. We also check whether the EVR-sorted portfolio can generate abnormal returns on FOMC days. This is our sorting result. Based on the construction, the first portfolio will be least sensitive to their FOMC announcement. Portfolio 10 will be most sensitive to their FOMC announcement. And we see those firms that are more sensitive to their FOMC announcement, they earn higher expected returns on FOMC days. And the long-short portfolio generates a spread of 31 basis points on each FOMC days. And we also find, interestingly, if we calculate the alpha based on either Fama Fringe 3-factor or the Fama Fringe 5-factor model, the portfolio alpha actually monotonically increasing over portfolios. Okay. These findings are also robust if we exclude the recent financial crisis, or if we exclude those firms with earning announcement days coincide with the FOMC announcement. Moreover, we run this CAPM type of regression, and we are mostly interested in this FOMC dummy. And in the table, we report the coefficient of this FOMC dummy, which is the alpha FOMC. And we can see, first of all, the FOMC dummy is monotonically increasing across portfolios. Secondly, the long-short portfolio was able to generate significant positive alpha, even with control for their market returns. To rationalize or to explain the empirical results or portfolio returns started on the EVR measure, we developed the structural model based on the information effect of Nikamara and Stice in 2018. Our intuition is the following. First, EVR measures firm level sensitivity with respect to FOMC announcement surprises. Second, the exposure to monetary policy surprises is risky because upon FOMC announcement, Fed reviews its private information about its interest rate target, which will in turn affect household expectation about the growth rate. To support the hypothesis of our model, we provide the following 3 empirical evidence. First, we find the EVR-sorted portfolio returns are monotonic in their sensitivity to monetary policy surprises. We consider 2 types of monetary policy surprises. The first one is unanticipated federal fund rate. The second is the composite monetary policy shocks within a 30-minute window of FOMC announcements. For both measures of monetary policy surprises, we find our EVR-sorted portfolio's return are monotonically increasing with respect to its sensitivity to the monetary policy surprises. Second, we also find our EVR measure is correlated with another firm level measure for monetary policy exposure proposed by Ozdali Velikov 2020, who used the firm level characteristics to construct this monetary policy exposure. However, when we include our EVR measure and their monetary policy measure in various Fama-Macbeth specifications, we find the price of risk of our EVR measure remains significant, robust in magnitude, and not subsumed by their measure. Thirdly, to support the information channel of our model, meaning the FOMC announcement could potentially reveal the information which can affect the household expectation for growth rate. We also investigate other macro announcements, and we find EVR-sorted portfolios actually generate a similar but a little bit weaker return spread on GDP or non-farm payroll announcement days. Arguably, on those GDP and non-farm payroll days, information about the economic growth will be reviewed. To summarize our empirical evidence, we find those firms that are more sensitive to the FOMC announcements, they earn higher expected returns. The long-short portfolio based on our expected sensitivity earn a spread about 31 basis points on each FOMC days on average. And this cross-section for returns cannot be explained by a CAPM model, which is very puzzling because the literature, especially Silva and Wells in 2014, has provided the convincing evidence that CAPM model holds well over major macro announcement days, which is also true if we sort stocks based on the market beta. Therefore, our model aims to reconcile the facts. On one side, a CAPM cannot explain the cross-section of portfolio returns if we sort stocks based on the expected sensitivity to FOMC announcement. On the other hand, CAPM can explain the market beta sorted portfolio pretty well. In our model, the representative agent has the recursive preference with the constant risk aversion gamma higher than 1/per. This is to capture the generalized risk sensitivity proposed by I and Benzo 2018. This preference will allow us to generate the risk premium associated with the micro announcements. In terms of dynamic of output growth, the output growth depends on two sources of shocks. One is independent productivity shock. The other shock is related with the Fed's interest rate target theta, which is modeled by this mean reverting process. Theta captures the impact of Fed's interest rate target on household expectation of growth rate, which will in turn affect the consumption growth eventually. And we provide more details about this new Keynesian model in the paper. Because theta is not observable, investors will have to rely on two sources of information to update. The first resource will be realized output growth. Investors will learn the true value about interest rate target through realized output growth with the posterior mean theta t hat and the posterior variance QT. On pre-scheduled FOMC announcement days, announcement will reveal information about true value for theta. Investor will update the belief accordingly. So this model is essentially consistent with the information channel of Newcomb and Stuyvesant 2018. This is the timeline of FOMC announcement schedule. On those non-FOMC announcement days, investors will have to learn true value about interest rate target through the path of output. On pre-scheduled FOMC announcement will reveal the true value for theta. Therefore, the posterior variance will drop immediately and uncertainty reduces. We further specify firm level dividend process as the following. The firm level dividend depends on its exposure to this unobservable interest rate target, which is captured by CASA I. It also depends on its exposure to productivity shock as captured by eta I. The third is the idiosyncratic risk. Because on announcement days, FOMC announcement will reveal information about the theta. Therefore, the return of stocks on FOMC days will be primarily driven by its exposure of CASA. Now, let me show you our model calibration results. So the first piece of empirical evidence is that those firms that are more sensitive to the FOMC announcement, they will earn higher expected returns, and the long-short portfolio generate a spread as high as 31 basis point per FOMC days. And the lower panel report our model calibration result. And we find our model can replicate these results pretty well. And we can see there is such one-to-one correspondence between implied variance reduction and CASA R. For those firms that are more sensitive to the FOMC announcement, as captured by higher value for CASA I, they will experience higher level of implied variance reduction. If we sort stocks based on CASA I, we are sorting stocks based on their exposure of the FOMC announcement. Therefore, we can generate the high return for those firms that have a high value for CASA I. At the same time, we're able to generate this long-short portfolio spread. The second important empirical fact is that the CAPM model cannot explain the cross-section of a portfolio returns well, right? And we find this FOMC dummy monotonically increase across the portfolios, and the long-short portfolios, FOMC dummy or alpha is significantly positive. And we find in our model, CAPM beta mainly depends on eta R, which is the firm level exposure to the productive shock. At the same time, it is also indirectly related with the CASA I. CASA I measures the sensitivity with respect to FOMC announcement. And CAPM beta is mainly driven by the firm's exposure to the productive shock, which is the eta I. Now, if we sort stocks based on CASA I, naturally the CAPM beta cannot generate enough spread. Therefore, CAPM model cannot fully explain their cross-section of portfolio returns sorted on their expected sensitivity sorted portfolios. Okay. To conclude, this paper documented that stocks that are more sensitive to FOMC announcement, they earn higher expected returns on FOMC days. And the capital asset price model cannot explain the cross-section of the expected sensitivity sorted portfolio, which imposes this puzzling that the literature documented that CAPM can explain the cross-section of stock returns pretty well on the announcement days. Therefore, our model depends on the information channel for Nikamura and Stuyson, and our model try to explain and replicate their empirical results. So that's all I wanted to say. Thank you very much for your attention, and I look forward to Michael's discussion.
All right. Thank you very much, Nick. Thanks for finishing just a little bit on time. So now I'll introduce you to Michael Weber, who is going to be discussing this paper. So Michael already shared his screen. He's ready to go. All right, go ahead.
Okay, well, thanks a lot to the organizer for allowing me to read and think about this very interesting paper. But before I actually go into the details, let me actually maybe first step back for a second. So if you think about a normal recession, oftentimes people are arguing that actually monetary policy might be the preferred tool for stabilization policies, because normally it takes quite some time for fiscal policy to get passed due to political friction and maybe other considerations. And actually, if you think about what ultimately monetary policy aims to achieve, they might want to stabilize the employment, output, and inflation. Yet, as we know actually from Friedman, monetary policy, of course, oftentimes is only effective with a considerable lag, which of course then makes it difficult to causally establish a link from monetary policy shocks onto those real variables, because it just takes quite some time until we might actually see that low frequency data, only quarterly data and things like that, which actually why over the last 10 or 15 years, there's been a quite vibrant and active literature trying to use actually high frequency financial market data as a laboratory or more magnifying glass to get an idea on whether monetary policy might be effective in affecting real outcomes and through which mechanisms and channels it might operate. And of course, you know, there's a plethora of possible channels through which we might expect that monetary policy might actually affect stock prices. You know, think about a classical credit channel, bank-dependent borrowers, or maybe a la more Kiyotaki-Moore, so a balance sheet type channel. You know, interest rates go down, this actually increases the value of my assets, and through that maybe firms start investing more. More recently, people have also argued that many firms actually have debt outstanding that is floating rates, and of course, similar to like a mortgage rate transmission channel to households, when we lower policy rate, they will actually then ultimately be reflected in those floating rates, and then also cash flow available for investment for firms might be higher, and of course also financial frictions. And I'll come back later on to one channel the paper pushes in particular, the so-called signaling channel of monetary policy, and what it actually means and how we can interpret that. And of course, then those things actually feed back into the real economy. So oftentimes, if you read FOMC statements or policy discussions, there's a direct discussion that, you know, if stock prices go up, you know, we might expect higher consumption through consumption wealth effect, or also like higher investment because of an effect via cost of capital. But actually what this paper now specifically tries to do is actually on the one hand understand what might help us understand heterogeneity in the exposure and the response to monetary policy, and then crucially come up with a measure to ex-ante construct exposure, and then ultimately rationalize that in a model. And so this ex-ante measure is actually this expected variance reduction Nick was introducing, and they show that firms that actually have a higher expected reduction should see indeed actually higher returns on FOMC announcement days, which they then argue on the one hand partially empirically, but also through the lens of a model, would be consistent with this information effect. So imagine now, you know, the Fed having private information. I'll come back to that later. This might actually result in an increase in target rates, and that ultimately is then interpreted by private sector firms, households, or forecasters as good news about future output growth. And as I said, so then they develop, as we just saw, a very nice equilibrium model in which actually the FOMC directly changes target rates and uses this to signal information about the economy. And actually, I really enjoyed this paper, a nice combination of empirical results and theory to help us understand potential mechanisms and channels through which monetary policy might actually be able to stimulate aggregate demand in the overall growth. So now actually let me start with my first comment. So this is a paper from a recent paper, or actually a couple of years ago already, I think 2012, by Korbio-Gortnichenko in the AHA Macro. There's been quite an active discussion why target interest rates are so persistent. And here what you are seeing is just, you know, over time, what is the Fed funds target rate, the Federal Reserve, or the Federal Open Market Committee, to be more specific, is setting over time. There's been quite some discussion why actually, if you look at the series actually is so persistent. And so some people have argued that it might be due to persistent shocks. Others have argued it might be due to a smoothing or some slow moving towards some target interest rates. And so if you now think back about the model Nick was presenting, so in the model, the authors assume that the Fed is actually moving target rate as a way to signal subsequent output growth to private sector participants. Yet actually in the data, it looks like this target rate is actually quite slowly moving. And in fact, actually, you know, for many, many years, oftentimes you don't see any action in the target rate, whereas actually in the model and empirically, what happens on any given FOMC announcement, so 8 times a year, there is news about the target rate, which then the private sector interprets about as a signal about future output growth. So I want the authors to think a little bit more whether indeed it might only be information, high frequency information about changes in the target rate, which this figure I think shows quite vividly, might be in fact not moving at high frequency, but actually be rather persistent and moving at a way slower frequency. And also in addition, but unfortunately here the authors are partially restricted by option metrics data. There has been some discussion that especially, more starting in the mid-90s, this degree of persistence and policy smoothing, in fact, actually substantially increased. So if they could come up with a way to maybe also measure exposure to monetary policy in the pre-option metrics period, this would at least allow them to directly check whether the effects might be stronger in an earlier sample where indeed maybe target interest rates were changing more frequently and were less persistent as in the second, which mainly overlaps with their own sample. Now what I'm plotting here is just, a simple event graph. Here you have day 0. This is any scheduled FOMC announcement from 94 until March of 2019. And what you see in blue and red is just cumulative returns of the CRISP value weighted index. And what I first want you to note is, so here this is the pre-announcement drift by Emmanuel and Luca Mönch, so the day or 24 hours before the announcement, independent of whether we have an expansionary shock in blue or a contractionary shock in red, you see stock returns tend to drift up unconditionally. And I should have maybe said expansionary shock here is just defined a la Kuttner. So think about Fed funds futures right before the announcement. What do actually markets expect the target rate will be? The Fed funds rate will be after the announcement. Look at actually what is realized, take the difference between the two, call that my Kuttner surprise. If actually ex-post realized policy is lower than expected, we call that expansionary, so looser than expected policy in blue. In red, this is contractionary policy, higher than expected Fed funds rate. So what you see in addition to this unconditional upward drift of Emmanuel and Luca, you also see actually for quite some time already before, but also subsequently, a sign-dependent drift in stock returns. So if actually a monetary policy announcement subsequently is expansionary, we see already 20, 25 days before, stock returns drifting up. Then we have the pre-FOMC announcement drift, and they continue drifting up subsequently. Whereas actually, before a contractionary surprise, not much is happening. If anything, we see a negative pre-announcement drift and flat returns subsequently. So what I was wondering, well, it's of course quite interesting that on the day of the announcement, we see this differential exposure to monetary policy, but to the extent you want to interpret this figure, I have here from a recent paper with Andreas Neuhiel, this might also be due to monetary policy. I think it would be quite interesting to see whether measures of exposure to monetary policy might also help us understand differential pre-trend in the cross-section of stock returns and post-trends before and after announcements based on the measure the authors are proposing. So now in terms of channels, so let me be a little bit more specific of what I think the authors mean by an information effect. So I guess all of us are now quite familiar with the forward guidance, and at least in the most classical and traditional way, a la Woodford, the way forward guidance works is that, let's say, Jay Powell announces today to keep interest rates at current or lower level until, the end of the liquidity trap. Then the agents in the model would interpret that saying, well, given that this will be inflationary in the future because the Fed should have raised rates, they don't do that, so therefore inflation will be higher in the future. The agent in the model takes it into account, updates expectations for inflation already today, and then through usual consumer oil equation logic should start actually consuming more, and this would then stimulate aggregate demand in a new Keynesian setting, and that's how forward guidance works, at least in the classical Woodford sense. So I think nowadays people would call that Odyssean forward guidance, that the Fed tells us something and then does not change the course over time, even if new information comes out. An alternative way how forward guidance might work is what Jeff Campbell and co-authors from the Chicago Fed have called Delphic forward guidance. So Delphic forward guidance means the fact that Jay Powell goes out today and tells us that he will not raise interest rates at least until 2023 might mean that actually he has very dire outlook about the economy. And the fact that he announces this today is signaling to private sector forecasters and firms and households that the economy is even worse than what everyone previously expected, or vice versa. If they actually then at some point would start increasing rates, this would be a signal about private information of the Fed that maybe actually COVID-19 will be ending sooner than expected, and the fact that they actually might increase rates should be interpreted as a signal by the Fed that actually news is good, and good news comes at the horizon. And that's the idea the authors have in mind. The Fed is changing interest rates, and private sector participants use this change in the interest rates as a signal about the economy. And so Nakamura-Steinson, a very nice QGE paper, were actually exactly arguing for that. But then actually, if we look at the contribution of conventional monetary policy shocks versus maybe an information effect of monetary policy, you see in particular in a sample until the start of the binding CLP at the end of 2009 that those signaling effects are mainly relevant on intermeeting policy changes. So what is an intermeeting policy change? So as Nick was saying, you have 8 scheduled meetings by the FOMC at any given year, but sometimes the Fed gets together, the FOMC, and meets in between 2 scheduled meetings. Even though the next meeting might only be 3-4 weeks away, they still change policy rates. And then already SAC in 2004 and earlier, people have argued the fact that they got together, even though the next scheduled meetings is only a few days away, might be actually interpreted that the FOMC really thinks actually way worse about the economy than what we all expected, and that then can be interpreted as a signal about the economy. So what I'm trying to say here is that this information effect or signaling effect should be particularly true on intermeeting policy decisions. And so I think actually it would be useful to differentiate different type of events, in particular in the sample until 2009. I think it's somewhat unlikely that on the regularly scheduled FOMC meetings, I personally would expect an information effect of monetary policy. Now, actually, one way to directly maybe show us whether this information effect is prevalent in the data, so oftentimes people look at how private sector forecasters change their forecast, let's say, about GDP growth after the FOMC meeting. And so to the extent, indeed, this long-short portfolio is effectively telling us something about exposure to news about future GDP growth, it should help us actually forecast revisions by professional forecasters, let's say, after the current FOMC meeting relative to the previous FOMC meeting, and using blue chip forecast or things like that for the same forecast period. So like say forecast for GDP growth until the end of 2021 or so, using those forecast provisions. I think this would be quite interesting and convincing evidence, for me at least, that we indeed might have an information effect. Now, more recently, there's actually a very nice paper by Michael Bauer, who's now at the University of Hamburg, and Eric Swanson, who both used to be at the San Francisco Fed, who actually in fact argue, well, it's has nothing to do, this signaling effect, with private information of the Federal Reserve relative to private sector forecasts, but instead actually it is really high frequency information the Fed is collecting until the day of the FOMC meeting, and then it's just their usual reaction function to macroeconomic news, and that ultimately then impacts monetary policy decision, which then ultimately exposed looks like as if the Fed is revealing information, but instead it's actually just incoming information. And potentially, one way to disentangle or at least ensure that it's not contemporaneous or almost contemporaneous macroeconomic news coming in, the authors could potentially use somewhat more high frequency data, for example, from the Chicago Fed Economic Activity Index, or some big data alternative that David Luca and co-authors have developed, and just actually try to purge, the part of the conventional Kuttner surprise that is due to economic news relative to maybe the conventional monetary policy, to help us actually understand what's going on in the data. And then in terms of now, type of news and events, so of course it's the case that not every single FOMC meeting is created equally. We already saw earlier that oftentimes for quite some period, actually target rates don't even change. Then actually when they start changing at some point, they continue increasing for quite some time, or vice versa. If they start decreasing, there's quite a high degree of inertia and policy persistence. So what some people have documented that, for example, results depend on whether we have expansionary or contractionary shocks. Stock markets tend to be way more sensitive to expansionary surprises. turning points, those first increases after series of flat or decreasing rates tend to be way more stimulative relative to any other change in policy rates. So I think actually it would be interesting to also disentangle different type of shocks and the heterogeneity by the sign of the shock. And of course, given that the sample for many, many years also incorporates policy that was effectively stuck at zero, so containing the liquidity period from 2010 until 2015 when they started lifting off again. So therefore, I would suggest, and there has been some nice work by Eric Swanson, who actually also made the shock series available online, who effectively shows it takes actually 3 shocks to be able to model the response of a panel of financial variables in narrow windows around FOMC decisions. The first one is a conventional Kuttner surprise. The second one is more like a forward guidance shock. And the third one is a large-scale asset purchase shock. So given that actually this liquidity trap period is a big chunk of the sample of the authors, I think it would be useful, especially for that very period. Also,
less than a minute left. So just
okay, so I'm already at my penultimate slide. So a couple of random rants. So I would, as a reader, I would just want to understand how actually persistent this measure of EVR is at the firm level, because I think most mechanisms I could think of would suggest that it should have some persistence. I also was a little bit puzzled by the high degree, even at the portfolio level, of heterogeneity in the EVR across portfolios. So like if you look at the summary statistics, so the mean EVR for portfolio 1 is almost -200, and for portfolio 10 is +200. So unless I was misreading the table, I would like to hear Nick what he thinks about this huge spread. I would also just, this is a minor point, in terms of the model, so the authors assume actually the prior beliefs about target rates are normally distributed. We just talked about the CLB, so clearly, we might want to think about whether a normal distribution might be an appropriate way of modeling it, given CLB that is binding. And yeah, I think that's pretty much all I wanted to say here. So really enjoyed reading the paper, thinking about it. I think it's already in fantastic shape, and there are only a few minor things I think the authors might want to address in a revision.
All right. Thank you very much, Michael. So we're just going to give Nick just a few minutes to address some of the comments while it's still fresh. And after that, we'll turn to the comments in the chat box, and we'll allow any participants to ask any questions if they wish. So Nick, go ahead.
First of all, I want to thank Michael for this excellent discussion. And I wonder if you could please share your slides with us so we can incorporate your comments in the revision of our paper. And I particularly appreciate your comments, or you share your vision or bigger picture about the channel of monetary policy. Although we agree it's the impact on the macroeconomy is indirect, there could be many channels why monetary policy works. And I really appreciate that you share your vision about the various different channels potentially could work. You also raised the question why monetary policy is so persistent. Although I think we cannot address all those questions in our current model, because we try to build the information channel with a relatively parsimonious model to explain the empirical facts, but that's something definitely deserves more investigation. In terms of the empirics, I want to address the first question, which actually your last slides, which is the easiest to address. You said the unit of EVR looks like pretty high. And I want to explain that EVR is based on the monthly percentage squared. And this unit of EVR is actually very comparable with the firm level. And we use the value weighted firm average. Therefore, we are pretty confident that the unit of EVR is correct. Also, you mentioned about how the result change if we split the sample into half based on the monetary policy scheme change. We can definitely try it. I guess it's going to be challenging because we only have, in our sample, we only have 176 FOMC announcements. But that's something we definitely can check. in terms of the monetary momentum, which is your Journal for Monetary Economy paper. And I think we can definitely check out whether firms will have different momentums. Also for different type of shocks for monetary policy or other potential channel of monetary policy affect the economy, we will definitely think about it, how to incorporate it in the revised version.
All right.
Overall, thank you very much.
Thank you, Nick. I'm now going to turn to the chat box. There are a few comments. So the first question here is from Fabrice Tour. And do you compare your firm level EVR measure to the exposed measure of exposure to Fed announcements? So how is that related? So that's the first question. And the second question here is that are firms with high EVR the same over time? So this is regarding to the stability. So Fabrice, if I'm incorrectly asking these questions, please feel free to unmute and ask. But Nick, do you have any thought on this?
So your first question is the firm level EVR measure to the exposed measure of exposure to FOMC announcement. So what we did is we run this panel regression of EVR on actual implied variance reduction. That's what we did. I'm not entirely sure, is that what you are asking? Otherwise, please let us know. Secondly, we investigated the the portfolio level sensitivity to Nakamura-Stuyvesant type of monetary policy shocks, but we did not try for the cross section for firms. Did you said the third question is firms with high? Okay.
Are they stable through time? Like firms with high EVR the same over time?
I fully respect you, Tim. Shall I move on, or you will ask another question?
Oh no, that's the question. Are firms with high EVR the same over time? How stable are they through time? Do you have?
So we checked the dynamics of our portfolio. Thank you very much for this comment. I think it's very much related with Michael's comment. Actually, in this current version of paper, we do not differentiate the contractionary or expansionary monetary policy shock, and we simply treat them equal, because in our paper, we do have a table showing on average monetary policy shock has a mean equal to 0, which is statistically different from 0. So to be short, in the counter version, we did not differentiate those two types of shocks, but we can definitely check.
All right. So the next question in the chat box is from Madhu Kalimipali. How do you disaggregated results? Your results look based on good or bad surprises. So I think this is related to the discussion questions before. So at this moment, I will ask if anyone here in the audience have any questions to address to the presenters or the discussants. Please feel free to unmute yourself. Oh, there's a question. Okay. So from Dorbislav, let me reiterate my comment from before that the stricter data-driven forward guidance in place since 2012 would dictate that relevant macro news announcement also matter for uncertainty resolution, given ex-ante commitment of the FOMC to act in accordance with specific data targets. Ditto for FOMC member speeches weeks ahead of FOMC meeting. Okay, this is more of a comment than the questions. So any other one else from the audience?
Yes, Dobry, your comments will be well taken. Thank you. Yeah.
Okay. Well, thank you very much, everyone, for participating. I just have a quick question, Nick. Yes. So from the model that you have, the channel of the monetary policy in effect in affecting the firm production output is through the dividend channel. Have you looked at the non-dividend paying stocks? Do they experience this cross-sectional heterogeneity in the EVR too?
That's a very good question, because in our sample, we focus on those firms with options traded. And I'm pretty sure some stocks will have no dividend. To be short, we did not differentiate, but the idea of our model is that their stock price, or we use dividend process to model their stock price, and the stock price will be more sensitive based on exposure to monetary policy shock. Yeah.
Okay, thank you very much.
I also have a question, if I may. Do we still have a minute?
Yes.
Yeah, we do have 1 minute. Go ahead, Emmanuel.
Okay, so yeah, very nice paper, very interesting. My personal take, I mean, Michael also mentioned my finding with David Luca that a lot of the FOMC Day returns we see in equities are actually earned ahead of the announcement. So also for your study, I think if you want to make progress in understanding what's driving equity returns on FOMC days, we need to really disentangle the pre and the post announcement return. And this, of course, is harder with options data, which haven't been available on day frequencies or higher frequencies than daily for a long period of time. But there is data available now for shorter sample periods. But I think I would urge you to go down that direction, and maybe for a shorter sample, look at really the reduction pre and post announcement, which I think is key to understanding what's really going on these days. And this is something that the paper I will be discussing does to some extent, but I think you should also look into this more carefully with, I mean, the data limitations, of course, in mind.
Yes, definitely. We actually have thought about it using the high frequency stock level option data to better identify the expected sensitivity. Secondly, to check this pre-announcement drift using the high frequency data, but the current version only focuses on a daily basis. Usually it's a very interesting point, which I believe gonna be a very interesting research area. Yeah. Thank you.
Thank you very much to both presenter and discussant. We're going to move on to the next paper for the interest of time. Just want to remind you here is that